AP, New York, with a half-point increase on Wednesday, the Federal Reserve's benchmark interest rate reached a range of 4.25% to 4.5%, the highest level in 14 years. The seventh rate increase this year by the Fed will make borrowing for homes, cars, and other purchases considerably more expensive for families and businesses. On the other side, you'll get a little bit more interest if you have money to save. The Fed raised rates by a smaller amount on Wednesday than it had in its previous 4 consecutive three-quarter-point increases as part of its efforts to combat excessive inflation. The downturn is partially due to the economy's cooling and the reduction of inflation. What you should know is what is causing the rate to increase. The quick response is inflation. Consumer inflation in the U.S. has been recorded at 7.1% over the past year, an uncomfortably high rate despite the sixth consecutive monthly decline. The Fed wants to reduce consumer spending, which will eventually cool the economy and drive down prices by diminishing demand for homes, vehicles, and other products and services. Jerome Powell, the chair of the Fed, has admitted that escalating interest rate increases would hurt people, but that they are required to combat high inflation. Who are the most affected consumers? Your monthly payments and your cost very drastically increase with the new rate, he said. It also has an immediate impact on people who have large credit card debt. Hoyt pointed out that despite recent increases, household debt payments as a percentage of income remain modest. As a result, many households may not immediately feel the effects of rising borrowing costs. The majority of consumers may not be thinking about interest rates right now, according to Hoyt. They appear to be more concerned with their shopping and the situation at the petrol station. The concept of rates might be challenging for consumers to comprehend. How will this affect credit card rates? Additionally, there are indications that Americans are using credit cards more frequently to sustain their spending while prices continue to rise. According to the Fed, total credit card balances have reached a record high of $900 billion. However, this figure is not adjusted for inflation. A survey research company's polling, according to John Lear, chief economist, reveals that more Americans are using credit rather than depleting the funds they built up during the pandemic. Rising rates may eventually make it more difficult for such households to pay off their obligations. People with poor credit scores who aren't eligible for low-rate credit cards already pay much higher interest rates on their balances and will continue to do so. Rates on home equity lines of credit and other types of variable interest loans will often rise in tandem with Fed rate hikes within 1 or 2 billing cycles. This is due to the fact that such rates are partially based on the prime rate of banks, which tracks the Fed's. Who are the affected savings? The rising yields on certificates of deposit, CDs, and high-yield savings accounts have brought them to levels unseen since 2009, thus families may desire to increase savings if at all possible. Bonds and other fixed-income assets now offer higher returns. In general, banks seek to take advantage of a climate with higher rates to increase their profits by charging borrowers higher rates without necessarily providing savers with greater rates. Does this have an effect on home ownership? The benchmark 30-year mortgage's average rate dropped to 6.33% last week, according to data from mortgage buyer Freddie Mac. Our average house loan's interest rate is therefore still roughly twice as expensive as it was a year ago. The benchmark rate set by the Fed doesn't always move in lockstep with mortgage rates. Instead, they frequently follow the yield on 10-year Treasury notes. If I'm still looking to buy, will it be easier to find a house? You probably have more possibilities now than at any point in the previous year if you're financially able to buy a home. If I want to buy a car, what do I do? According to Edmunds.com, the average new car loan has increased by more than 2 percentage points from 4.5% to 6.6% since the Fed started raising rates in March. Loans on used cars have increased by 2.1 points to 10.2%. The average loan term for new cars is just under 70 months, and it has beyond 70 months for used cars. According to Ivan Drury, head of insights at Edmunds, financing a new car with an average MSRP of $47,000 currently costs $8,436 in interest. That alone will drive many people away from the car industry. According to Drury, I think we're actually beginning to see that these interest rates are doing what the Fed wants. They are reducing purchasing power so that you are unable to purchase a vehicle. The number of those who can afford it will decline. Any rate hike by the Fed will probably be passed on to car loan borrowers, albeit it will be perhaps partially mitigated by manufacturer-subsidized rates. According to Drury, when demand slightly declines in the coming year, new vehicle costs will start to decline. How have rate increases affected crypto? Because their yields have increased, safe assets like treasuries are now more appealing to investors due to higher rates. As a result, risky investments like tech stocks and cryptocurrency become less alluring. However, issues unrelated to economic policy still plague Bitcoin. Investors' faith in cryptocurrencies has been shaken by the failure of three significant organizations, most recently the well-known FTX exchange. How is my job doing? Some economists contend that in order to stop price increases, layoffs may be required. One claim is that a labor market that is too tight leads to wage increases and greater inflation. But in November, firms across the country continued to hire quickly. According to Odeta Kushi, an economist with First American, job postings continue to surpass job hires, indicating firms are still struggling to fill vacancies. Borrowers who obtain new private student loans should be ready to make higher payments as interest rates rise. Currently, interest rates on government loans range from roughly 5% to 7.5%. That being said, as part of an emergency measure put in place early in the pandemic, payments on federal student loans are frozen with no interest until summer 2023. Additionally, President Joe Biden promised loan forgiveness of up to $20,000 for Pell Grant recipients and $10,000 for most borrowers, a measure that is currently being contested in court. Are the rate hikes likely to be resolved?